Real estate investment trusts, or REITs for short, are a great way for investors to generate passive income. In fact, on this channel, I buy and I own many REITs myself, and I absolutely love REITs. A REIT is a company that owns and operates various different types of real estate. The main thing that separates real estate investment trusts from a regular stock company is the fact that REITs must pay out 90% of their income in form of a distribution or dividend. So because of this, REITs offer a great way for investors to generate more passive income from their investments. And of course, REITs are also a great way to add just a little bit of extra diversification to your portfolio. Now, even though I absolutely love REITs, and I own many of them myself, there are some risks and some things you need to consider before you go out and buy as many REITs as you possibly can. So if you guys are enjoying this video so far, be sure to give it a big thumbs up, and if you guys want more Canadian-based dividend investing and REIT investing videos, be sure to subscribe to the channel. So now, before we go into the dangers of REITs and some things we need to consider before we buy REITs, let's spend a little bit of time in basic detail talking about how REITs work. Now, because the REITs generally pay out about 90% of their income to shareholders, this basically means that REITs tend to have a higher dividend yield than most dividend-paying stocks. This is what makes REITs so attractive to beginner investors, because at the end of the day, when you're comparing dividend yields, who wouldn't want a higher dividend yield than another stock? Some REITs will focus on one area or one sector, while other REITs will be more diverse and focus on a lot of different sectors. Here is a very basic list of the common types of properties that real estate investment trusts generally consist of: healthcare facilities and homes, hotels, apartments and apartment complexes, office buildings, storage facilities, retail stores, malls, and many more. And of course, the most attractive thing about REITs is that it allows investors to invest into real estate and start earning passive income without actually going out and buying the property themselves. By purchasing REITs and adding them into your portfolio, you won't have to worry about anything such as researching and taking the time to buy property. You also won't have to fork out a large sum of money and able to buy the property in the first place. In fact, most Canadian REITs actually trade at a very low price, and you can buy REITs for around $10 to $15 per share as of right now. If you are investing into solid REIT companies, you can enjoy the benefits of real estate and start earning some passive income from real estate without dealing with any of the headaches that come alongside actually owning real estate. That's the power of REITs. Now, before you go out and spend all your hard-earned money on REITs, let's start talking about the downsides, or at least the things you need to consider before you buy REITs. So the very first thing we need to talk about is publicly traded REITs versus private REITs. Generally speaking, you want to make sure that you are sticking to publicly traded REITs that are traded on the stock market. Private REITs are far more risky, and it's really hard to research into them and get an overall value of them because the information just isn't available. When it comes to publicly traded REITs, you can see all the financials, you can see the holdings, and you can do much better research, and the companies, generally speaking, are going to be a lot better when it comes to publicly traded REITs. Private REITs generally have higher fees, and you really don't know what you're buying when it comes to a private REIT, and unless you know what you're doing, I generally recommend that beginner investors stay completely away from private REITs and just focus on public REITs. In fact, I myself only hold public REITs, and these are REITs that you can buy on the stock market exchange. So my first tip and the first risk you need to be aware of is to stay away from private REITs, and instead I highly recommend that you focus on publicly traded REITs. Second major risk that comes from real estate investing and investing into REITs is that REITs are a victim of high interest rates. And this is probably the biggest risk when it comes to investing into REITs, because in a high interest rate environment, this will decline the actual value and the demand for people to purchase REITs and buy REITs. When interest rates rise, investors will generally pick safer investments and will move away from REITs, and sometimes this can cause a REIT sell-off where REITs will lose a lot of their value. Now, this doesn't always happen, but generally speaking, when interest rates rise, REITs tend to underperform compared to the regular market. Now, if this is just a temporary thing, this can create a good opportunity to buy REITs, but if high interest rates hang around for a long time, over an extended period of time, we can see REITs really underperform in the long run. So interest rate increases are definitely something to consider when you buy REITs. Now right now, interest rates are historically low, but the problem with right now is nobody really knows what's going on with the market, and nobody knows what's going to happen with real estate going into the future. With interest rates being really low right now and the ability to buy real estate being cheaper than it has ever been before, ideally you would think that REITs might grow in the future. But the problem is nobody really knows what's going to happen with the markets. Nobody really knows how the economy is going to do going into the future. So nobody really knows what's going to happen with real estate. So as of right now, it's really up to what you guys think if you want to buy REITs or not. I still think REITs are worth buying right now, but going into the future, nobody really knows what's going to happen, and nobody can predict what's going to happen in the market going into the future. Overall, I think holding some REITs inside your portfolio is always a good idea, but I would never recommend going crazy with REITs, because what this can do is if REITs do tend to underperform, you will lose a lot of money going into the future. The better option, in my opinion, and this is what I've done, is make REITs a small percentage of your portfolio so you can benefit when real estate goes up. But if REITs do suffer from a period of time where they actually do underperform, at least you won't be losing the bulk of your investment, and you'll have your other investments that help bring up your earnings overall. The last mistake and the biggest risk that a lot of beginner investors make when it comes to buying REITs is that they don't research into the REITs and they just buy a bunch of bad, crappy REITs. You never want to overinvest into one REIT, and you never want to buy a REIT just because it's got a high dividend yield. Avoid this mistake, and this is a mistake that a lot of beginner investors make. Make sure you research your REITs. Make sure you look at their finances. Look at how much money they are borrowing. Look at how much money they are making on a monthly basis, and check out things like cash flows and payout ratios, because this will give you a good idea on how well that REIT is going to perform into the future. And last but not least, the probably most important factor is check to see how well this REIT has done over time. The longer period of time as REIT has been around for, the better, because then you can look in the past, see how well they've done, and this is probably the best indicator of how well they're going to do going further into the future. And it's also a good idea to diversify your REITs as well. Investing into an ETF is never a bad idea, and this can help diversify your REITs just in case if one sector or one area takes a really big fall, at least all your REITs won't suffer. Now, I personally love Canadian REITs, and even though probably about 100% of my REITs right now are Canadian REITs, I've made sure to invest into different ETFs, and because of this, I made sure that my REITs actually only represent a small percentage of my overall portfolio, just in case if a real estate crash does happen in Canada, at least I'm not going to suffer major losses. Just like dividend stocks, it's important to do your research and know what companies you are investing into. So take the time to learn about your REITs, take the time to look at their past experiences, and take the time to look at their finances so you can get a better idea of how well that REIT is going to perform going into the future. Now let's spend some time talking about taxes, and when it comes to REITs, this is probably one of the bigger mistakes that beginners make. And this isn't necessarily a risk per se, but if you don't do your taxes right when it comes to REITs, or you don't understand how taxes work when it comes to REITs, you can actually lose a lot of money. So I do kind of classify this as a risk. So as of right now, REITs are generally currently taxed as ordinary income. So you will be taxed on your REITs depending on how much money you make and which tax bracket you fall into. If you are investing a very large amount of money into REITs, it's always a good idea to stick your REITs in some kind of tax-free savings account or some kind of portfolio that allows you to earn income and your dividends from your REITs tax-free. So if you are a Canadian, it's not a bad idea to open up a tax-free savings account and stick your REITs in there, since all those nice yields that you'll be getting from those REITs, you'll be able to earn them over time, and they can compound tax-free. If your REITs are not in a tax-free savings account, you can lose a good chunk of your money. And remember, because your dividends will get taxed, and because a big chunk of those yields from REITs do come from dividends, you want to make sure that you keep as much of that dividend income for yourself. This is something that going into the future, as my REIT portfolio grows, I will probably consider doing. Probably going towards the end of this year, I will probably transfer some of my REITs into a tax-free savings account, as my REIT portfolio is slowly starting to grow and the monthly income is starting to add up. So overall, I think REITs are a great way for investors to add another form of passive income and add a nice diversification to your portfolio. Just make sure that you're buying solid companies and try not to get sucked into companies that have high yields but crappy returns. Just make sure that you invest into companies that are solid and try to avoid companies that promise high yields because they then tend to underperform in the long run. Remember, you want solid companies that have consistent growth, but it's important that not only do they have a good dividend yield, but they also grow in value over time. And remember that when interest rates rise, REITs can underperform, and if there is any real estate crash for over extended period of time, your REITs will probably suffer as well. And probably the best thing you can do is stick your REITs into a tax-free savings account so you can earn more income and you give less money to the government. So overall, I think REITs are a great opportunity. I think they're a great way to invest. You just have to understand some of these little risks, and just like stocks or anything else, there are risks when it comes to investing with REITs. So hope you guys enjoyed this video. Let me know what you guys think of this video in the comments. Are there any things you would like to add to this video or anything you would like to share? Feel free to do so. And if you guys did enjoy this video, please give it a big thumbs up and consider subscribing to the channel. Hope you guys enjoyed this video. I'll see you guys later and have a good day.